Hi Fools, I'm David Williamson and welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. Let's go right into who's winning today. And our first winner is Chelsea Therapeutics. Shares are up over 20%. Why? Because Northera was approved. The FDA delayed the decision from Friday, which is the date everyone had circled, all the way till Tuesday, but we do have an answer. The FDA this time will side with their advisory committee's overwhelming support of this NOH drug. Of course, the first time around, the FDA rejected Northera despite a positive AdCom vote. Not the case this time. Questions still remain about the durability of efficacy of this drug, so patients will need to be monitored after 2 weeks to see if it is still working. Chelsea will need to run another trial that answers this durability question, but they have over half a decade to get it going, and I expect some serious foot dragging when it comes to this. You know, once your drug is approved, there's often little upside to phase 4 studies, and so we usually see them very slow to enroll, as they're generally on the back burner for these companies. The front burner, of course, is launching the drug and getting sales, which is where Chelsea will be. We've seen some tough launches lately. I don't necessarily anticipate this one to be. It really depends on expectations, but you know, we've seen generally large run-ups to approval, and then shares struggle unless sales are really good out of the gate. So that's something to watch going forward with Chelsea. All right, our next winner is FurieX, which is looking to put itself up for sale. Its IBS drug aced its phase 3 trial, setting shares up 130% in a single day. It was a classic biotech instant double. The company popped slightly after reports came out that it was looking for a buyer. It's since traded back down near flat. I think the market realized that finding a buyer is a lot easier said than done. There are a lot of small biotechs that would love to be bought out at a hefty premium. FurieX does have a good-sized market, and it treats a chronic condition, so it could find some interest out there, but there are some safety issues with its drug as well. We'll be watching the story closely at Fool.com. Now, our third and final winner today is Eli Lilly, which really could have used a big win, and they certainly got it. It's one of its lead drug candidates, ramucirumab, in a phase 3 trial called Revel, produced very strong results in second-line non-small cell lung cancer. It achieved statistical significance in overall survival and progression-free survival. In plain English, that means it clearly beat the control group in disease progression and in overall patient survival time. Again, Eli Lilly did need a hit. Shares are up 5% on the news. This is a drug that's been tested out in several cancer types to mixed results. This appears to be one of its better ones, and this is a great opportunity for Eli Lilly. So great news for the big pharma and great news for its investors today. All right, moving on to the other side of the coin, the losers. First up, we have Prana Biotech, which released phase 2 results for its flagship drug candidate PB2 in Huntington's disease. Shares are down over 10% today. Now, Prana's drug hit its safety endpoint, but there's a pretty sizable debate over its efficacy. Prana is saying it's a success, but that came from pooled results in part of the patient populations. Others are saying that if you just take a look at the data on its own, it didn't hit any of its endpoints, so it was not successful in helping with cognition. The drug's also being tested in Alzheimer's, but that is notoriously difficult to treat despite well-funded big pharma efforts. I'm sure Prana is going to continue to advance this drug into phase 3. It will be one to watch because any success there would mean any efficacy success would mean huge sales success, but investors need to be cautious with drugs in this space no matter who's making them. We've seen you know, big companies like Johnson & Johnson and Eli Lilly get burned, so Prana is certainly a riskier pure play on this. Now, our other big loser today is Medbox. It's getting hammered by Citron Research. For those unfamiliar with the stock, it offers marijuana dispensing machines, sort of a red box for pot, and consulting services for distributors. The stock is holding up pretty well. It's down only 7% after the famed short-selling blog called it worthless in its latest post. Now, Citron attacked the validity of Medbox's financials and the history of its CEO. Medbox has been on quite a tear lately. Shares popped 26% last week after the Obama administration outlined how banks can work with the legal marijuana businesses, which up until now have been hoarding cash in states that allow them to sell the drug because they aren't allowed to put it in a bank. Investors are looking for good ways to play what could be a coming marijuana sales boom, but I really want to urge some caution. It's the Wild West out there when it comes to this industry. We have a lot of over-the-counter stocks and penny stocks, so please invest with caution and perhaps even wait a little longer to see how policy changes continue at the state level, at the federal level, and we'll see who the real players are, who shakes out of all of this thing. But it's definitely an exciting space and one that deserves watching. And as far as what I'm watching, it's Warren Buffett. Now, the noted investor sold his position in Big Pharma GlaxoSmithKline. So that leaves the question, is Buffett abandoning healthcare stocks? And the answer is no. Berkshire still has healthcare in its portfolio as of its most recent filing. There is, a negligible, for Buffett anyway, stake in Johnson & Johnson worth $30 million. There's a much larger stake in the European big pharma Sanofi worth roughly $210 million. Finally, Berkshire has a $2.3 billion position in DaVita Healthcare Partners. Now, DaVita is the dialysis service, and Berkshire is its largest shareholder. Now, I would take this news slightly as a negative for GlaxoSmithKline, only in the sense that the world's foremost super investor finds the stock, whether through its growth potential or its current valuation, not super enough in itself. And valuations have gotten high in the sector, especially for pharma and biotech stocks. That's what makes DaVita stand out. Buffett aggressively accumulated shares all of last year. The stock ran up 20% over the last 6 months, but it still remains cheap when factoring in its growth via acquisitions like Healthcare Partners for $4.5 billion, and it also has an aging population as a tailwind that will have an increased need for its dialysis services. The company could be subject to Medicaid and Medicare reimbursement cuts, so it's important for investors to keep an eye on Washington as they're focused as they're also focused on how the company is operating on a business stance. Policy will affect this company. So I recommend investors look through Berkshire's disclosures. It's always interesting to see what Buffett is up to, and you may find some stocks you like. You could also just go out and buy shares of Berkshire and save yourself the heavy lifting. Full disclosure, that's what I did, but it's always interesting to see what Warren is up to, especially in the healthcare space where he doesn't have a whole lot of different positions, but he does have some. Thanks for watching. Stay tuned to Fool.com for all your healthcare news, and Fool on.